Where's my market reaction?
Well, I think a lot of this was priced in and it needed to happen. So it's good that it does happen. I think markets were anticipating that you're not going to see any tightening out of the ECB for a long time because the economy is turning down. I mean, they cut 30 basis points off the projection for this year for GDP in 1 quarter or 2 months, right? It really has the amount of softening across the European economy is meaningful, and it made sense that they wouldn't tighten it all, and they needed to replace the support they've given to the banks, which I think was priced in.
So, Bill, I'm curious for your view on this. Can they do this with monetary policy? Don't they need some fiscal stimulus to get the growth going?
When the news was being read, I thought of an old song. Nothing from nothing leaves nothing. You got to have something if you want to be with me, right? And so here's all these cheap equities over there in Europe, and an economy that just has floundered. And what I thought about yesterday was that 8 to 10 years ago, the United States led the way by recapitalizing our banks. So the way out for Europe, and I know this sounds bad, is if you look at the demographics of the United States, we're going to add about 30 million people to the key 30 to 45-year-old age bracket. And there's some similar demographics to that in the European countries. So what happens is most of the borrowing and household formation and living, kind of George Bailey's It's a Wonderful Life, do the living and dying in this country and those countries, will start happening. It just hasn't coalesced yet, but first the United States will accelerate out of this, and then it will drag the rest ahead. And ironically, I know this sounds outlandish, my guess is 8 or 10 years ago, people are going to be hassling policymakers, because remember, there's been a huge amount of money created, from the financial crisis and still floating around the world. We see it flowing in and out of securities all the time. And at some point in time, when those people coalesce and we do see a significantly stronger economy in the United States, then you're going to have the opposite problem, which is prices will get bid up. And I know that's very contrary to what you're hearing.
Shaking his head.
Mark, demographics are going to save us?
I don't think that the monetary policy that the ECB is following is actually working. I'm not a big fan of negative rates. It's hard to price assets with negative rates. It doesn't make any sense when your banks have to pay to keep their reserves.
Doesn't matter how many teltros
right.
you're going to go take, right?
It is, negative rates are negative. And Europe is much more exposed to China, and we talk a lot about trade, and we think, gosh, we get a deal, and suddenly everything's going to be sunny days. What happens with trade policy is it takes a very long time for that to work through the economy, and what you're seeing now is really the effects of the fact that we've had a trade war. Right, and we've got tariffs that are kicking in. We've had slowdown that is happening across the European theater, and that is something that they're going to have to deal with fiscal policy. To your point, right? And I'm not sure that that's really in the cards here. So, I don't look at this as good news in any way, shape, or form. If you look at PMIs, you look at yield curves, there's a real growth problem across domestic developed economies. And so I'm not really sure how this makes us feel as far as risk premium across a lot of asset classes. And I think there needs to be a pause. I'm glad to see that they're dovish here. But the question is, what's next? I mean, do we get a deal, and does that make everything better? No, I don't think so.
Well, fair point. And sort of now the rhetoric, everyone wanted this, but then now it's like, oh no, that means something's really bad. So, Bill, to you, how much risk do you want to be taking on right now?
Well, but let me just kind of extrapolate on what Mark's saying. People are afraid, for example, that the people I'm talking about, the ultimately 95 million millennials versus the 65 million Gen Xers, that they won't buy a car. For example, people have this vision they're all going to ride in an Uber or a Lyft, and that works really well while you're single and while you're living in a concentrated large city. But that's also a big change that we see coming. So I agree with you. In other words, what I'm saying is, we're the engine. We were the bank engine. We recapitalized our banks back to health 3 or 4 years before everybody else did. And I think Mark's right. We'll come out the next 2 or 3 years, and what'll happen? There'll be a lag of, maybe 3, 4, 5 years? Yeah, you sound like you don't think it's ever going to happen, and that's, you know.
I'm not a bear in here. I just think that it won't. I'm a credit guy, right? So we talk a lot about what's happening in the credit markets, and the credit markets have gotten back to kind of averages. I mean, where long-term averages of where spreads are, and we talk about percentiles. So things sold off very hard in the fourth quarter. They bounced a bit. We're still not kind of back to new highs, which is good. But I think given the amount of debt in the world, we can talk about the amount of debt in sovereigns. We can talk about the amount of debt in corporates. You need to have a higher risk premium against a growth challenged world. And so it's sort of like we're in this situation where, yeah, we bounced a bit, but is it a dead cat bounce? It probably feels that way. I think it's a little
talk
bit
about
wider.
the amount of debt, because we have two different things. The amount of debt and total numbers, nominal numbers, is enormous, whether it's the United States or worldwide.
Yes.
Then other people say, but yeah, if you compare it to GDP, you're compared to earnings of corporations, it's actually not that high. What's true?
Well, it is very high when you think about what happens when something goes wrong. Okay, so we just had this Pacific Gas and Electric bankruptcy. It went from investment grade to bankruptcy in a month. Okay, these bonds went down 45 points, right, on a $20 billion cap stack. So this is the sort of environment that we're in. When something goes wrong, the price movement is going to be meaningful. Now they bounce back, and we've stepped in, and we think these are good things to own when people are panicking and having to sell. But that's the kind of risk that's embedded when you have this much debt.
So the history of world economies is, how do governments get outside of a debt? What is the most effective way for a government that owes somebody too much money to get out of it? And that is inflation. That you inflate your way out of the problem. If you can get everything else to go up in value, if prices rise and you make that debt less valuable by virtue of inflating your way out of the problem, that's the normal modus operandi. And the irony, and I think Mark is correct in saying this, is it's kind of interesting to watch that they don't seem to have any ability to Europe to try to inflate their way out of the problem.